Okay, so you want to buy a bank. Not just any bank. A bank in the 5 places on Earth where the world's richest people actually keep their money. Switzerland, Singapore, Luxembourg, Monaco, the UAE. Same business everywhere. Take deposits, lend them out, pocket the difference. But 5 completely different price tags, 5 completely different sets of gatekeepers, and 5 completely different ways this can end your career. By the end of this video, you'll know exactly what it costs to buy your way into each one, and why the richest country on paper isn't always the hardest one to actually get into. Stop 1. Luxembourg, the easy door into the big leagues. Luxembourg is where the fund management industry basically lives. Trillions of dollars managed out of a country of 670,000 people. To open a bank here, the CSSF and the European Central Bank require a minimum paid-up capital of 8.7 million euros. That's the smallest capital requirement on this entire list. Approval takes 12 to 24 months, and once you're in, you get EU passporting, meaning your bank can operate across all 27 EU countries without applying for a second license anywhere. This is the starter move for anyone serious about European private banking. But Luxembourg's reputation took a hit in 2014 with LuxLeaks, a leaked cache of secret tax rulings that showed hundreds of multinational companies were using Luxembourg structures to gut their tax bills, sometimes down to under 1%. The country wasn't doing anything explicitly illegal, but the leak turned boring, respectable Luxembourg banking into a global scandal overnight, and Brussels spent years afterward rewriting EU tax transparency rules because of it. Stop 2. Monaco. Money isn't the gatekeeper. Monaco only requires 5 million euros in capital to license a bank. Less than Luxembourg. Should be easier. Right? Wrong. Monaco has no EU passporting rights. Its licenses are actually issued by France's own banking regulator, and there are only around 35 banks in the entire principality. It is functionally a closed club. Even as a customer, not an owner, you need at least 500,000 euros to open an account as a resident, and 2 million euros or more if you're a non-resident. There's no online banking sign-up. Monaco banks want to meet you in person before they'll even consider you. This is the one place on the list where the number on the license application isn't the real barrier. The real barrier is who vouches for you. Stop 3. Singapore. The door is basically closed to newcomers. Singapore's MAS doesn't really hand out new full retail bank licenses anymore. That door is closed to almost everyone. The realistic paths in are a wholesale bank at roughly 15 million Singapore dollars in paid-up capital, or if you want to go all in, a fully licensed digital bank at 1.5 billion Singapore dollars. Singapore built its reputation as Asia's cleanest financial hub. And then, in 2015, that reputation took a direct hit when the 1MDB scandal broke. 2 Singapore-based private banks, BSI and Falcon, were found to have moved money linked to the multi-billion-dollar Malaysian fraud. MAS didn't find them. It shut both banks down completely and pulled their licenses. A reminder that in Singapore, the regulator doesn't just watch you, it can end you. Stop 4. UAE. The biggest number on this entire list. If you want a full commercial banking license on the UAE mainland, the central bank requires a minimum of 2 billion dirhams in fully paid-up capital. That's roughly $545 million. By far the largest capital requirement of any country on this list, more than 60 times what Luxembourg asks for. There is a cheaper side door, DIFC, Dubai's Financial Free Zone, will license a Category 1 bank for a base capital of just $10 million. But you're then confined to DIFC's own jurisdiction and can't freely serve UAE mainland retail customers. The UAE built this 2-track system deliberately. A low capital, high scrutiny express lane for global finance firms and a 9-figure wall around the actual domestic banking market. Stop 5. Switzerland. The one everyone actually wants, Switzerland's FINMA sets a statutory minimum of 10 million Swiss francs, but no serious application gets approved with that number alone. Realistically, you're looking at 20 million Swiss francs or more, plus another 500,000 to 2 million Swiss francs just in legal and advisory fees over a 12 to 24-month review. FINMA doesn't just check your balance sheet. It checks the personal conduct and reputation of every major shareholder and director, what it calls guarantee of irreproachable business activity. This is the hardest door to walk through on this entire list, not because of the money, but because of the scrutiny. And even Switzerland isn't bulletproof. In March 2023, Credit Suisse, a 167-year-old institution, one of the most recognizable private banking names on earth, collapsed in a single weekend and was forced into an emergency takeover by UBS. If the most prestigious banking brand in the most rigorously regulated banking country in the world can disappear in 72 hours, no license anywhere guarantees survival. These 5 by entry capital alone, and UAE wins by a mile at $545 million,